Good morning, everyone, and welcome to our webinar for September month. We'll begin as usual in America, where things have been happening. The Fed has suddenly started talking about tapering off the quantitative easing that it's been doing for quite a long time. At the moment, it's been buying $120 billion worth of assets every month. In other words, it's been printing and injecting $120 billion a month into the American economy. And it's now talking about reducing that in a process which is known as tapering. Obviously, this is quite a significant change of policy, and they're talking about doing it before the end of 2021. And that obviously means that they are becoming a little concerned about the high inflation rates in America at the moment. And it does possibly signal a change of policy. Anyway, the effect of this suggestion that they might begin tapering off the quantitative easing caused the S&P 500, which should be on your screen now, to go into a little mini correction, another mini correction. But the bullishness overwhelmed it, and it returned to new record highs, as you know, and you can see that on the chart here. So we're now back up at record highs, and we've also broken through the psychologically important level of 4,500 on the S&P 500. Of course, the bull trend is still intact, but we want to continue to warn you that we believe that there is a major correction coming and that it will be between 10 and 20%. That major correction will not be the beginning of a new bear trend, in our opinion. Rather, it will be a buying opportunity. It will take the market down. There will be a lot of negative talk for a while, and blue chip share prices will come off somewhat, and that will present you as a private investor with a buying opportunity. Of course, eventually, rising inflation in America will bring this bull trend to an end. But that will only happen when there are sufficient interest rates hikes in America to start to threaten S&P 500 companies' profits, and we're far away from that yet. I think that what will happen now is that the tapering will begin probably early next year, and it will continue throughout the year, and only when the tapering is finished, in other words, when the American government is no longer printing money and injecting it into the American economy, will they consider raising interest rates, and then the first few interest rate rises will not necessarily derail the bull trend. It's only when those interest rate rises become significant enough to start impacting on S&P 500 company profits that we should see a significant downward trend in the S&P 500. So the bear trend is some months away, some years away possibly, but before that bear trend begins, there will be a major correction which will look like the start of a bear trend. And probably some analysts will interpret it that way. But our view is that it will be a buying opportunity, just a correction. Obviously, the S&P 500 now above 4,500 and still rising exponentially, totally based on the money that the Fed is printing and the growing Fed balance sheet. And we all know that this cannot be sustained indefinitely. So at some point, this great bull market will come to an end. But in our opinion, it's not right now. We have spoken previously in previous webinars and in articles about a process which we describe as the elimination of the bears. And this process is something which occurs during a great bull market like the one that we're in now, where an expert, some expert in the economy, a fund manager or somebody like that who's fairly well known, will stand up and publicly say this is the top of the market and you should get out and sell all your shares and run for cover. And then what happens, of course, is that the market goes up again further and makes new record highs, and that particular expert is discredited somewhat and basically goes out of circulation. The first example of that we had in this great bull trend was George Soros, who 3 or 4 years ago decided that the market was at its top and he went heavily short on the S&P 500. When he was proved wrong, he doubled up on that bet. But now we don't hear anything from him at all. He must be feeling very uncomfortable with the S&P now at 4,500. More recently, we've had a guy called Michael Burry, who's well known as a fund manager in America. And he has decided that, yes, we are in a bubble and that bubble will burst, similar sort of rhetoric. And he's taken out two massive short positions, one on Tesla stock and the other one on the ARK ETF, which is run by a lady called Kathy Woods and has about 10.4% of its money in Tesla. So this is really a short on Tesla. So he's saying the entire market will fall, but Tesla will fall furthest. So that's where he is. Of course, what you've got to remember is that he has been virtually wiped out during 2020 because of that short position, because Tesla's stock has gone up at least sixfold during 2020. He originally came to fame, I'm talking about Michael Burry, came to fame when he shorted the US property market during the subprime crisis in 2008. And on that occasion, he got it right. And because he got it right, he made a fortune. He made $100 billion out of it. And he acquired thousands of followers as a result. But this time, I think he's definitely got it wrong. And that's what is being shown to me here in the figures. When you look at Tesla, particularly, I would think it's a little foolish to go short on Tesla. It would be better to go short on Ford or General Motors. General Motors is sitting with a debt of $186.6 billion, and Ford has got a total debt of $226 billion. This compares with Tesla, which has just had its most profitable quarter ever and only has $25 billion in debt. Both Ford and GM have had declining sales for the past 2 years. Another interesting fact about Ford and GM is that they both spend roughly $4 billion every year on advertising their motor cars. Tesla spends absolutely nothing. And the reason for that is that the company Tesla has 4 million Twitter followers, and Elon Musk himself has another 29 million Twitter followers. So they really don't need to advertise. What they've done is built a better mousetrap, and the world is busy beating a path to their door. Another famous activist short seller is David Einhorn, who's also shorting Tesla. He started off with a fund worth $12 billion, and that has now been reduced to $1.6 billion as Tesla climbed 800% last year. Clearly, it's not smart to bet against Elon Musk. He's had a lot of successful companies. If you look at him, he's had a lot of successful companies. Zip2, PayPal, SpaceX, Neuralink, Starlink, the Boring Company, and of course Tesla itself. So Burry and Einhorn are joining a growing list of discredited bears as the bull rages on. If we look at the US economy, we can see that it grew 6.6% in the second quarter. That's much less than the 8.5% which is generally predicted by economists over there. And that was mainly because of supply chain problems, delivery delays, and stockouts. These stockouts and delivery problems are blocking the system up and have slowed down growth in America. But of course, stockouts will cause prices generally to go up. People will pay more if they can't get a product, if the demand is great. But we believe that the economy will get a tremendous boost from restocking during the second half of 2021. So look out for that in America. Inflation in the second quarter came in at 6.1% in America. That's the highest since 1983. The Monetary Policy Committee over there says that this inflation is temporary, due mainly to the low base in 2020. But we are not so sure. If it continues, it will force a more hawkish stance and trigger a major correction. Of course, the MPC, the Monetary Policy Committee in America, says that this inflation is due to the low base in 2020 and therefore it's temporary. We are not so sure. One thing we are certain of is if the inflation continues and particularly gets worse in America, then it will force the MPC to adopt a more hawkish stance, and that could cause a major correction on the S&P 500, which is what we have been predicting. But of course, the bull market in world markets continues. Amid growing optimism, the pandemic appears to be under control and vaccination levels are rising throughout the world. Massive and persistent monetary policy stimulation is impacting on consumer spending. New disruptive technologies, not least of those which are being introduced by Elon Musk, are boosting productivity and reducing costs. The oil price is still 50% below its peak level and may go lower as electric vehicle sales increase. Finally, inflation does still seem to be under control, at least for now. So our perception of America is that the bull trend will continue. However, there may be a major correction, and you should watch out for that and use it as a buying opportunity. Turning our attention to South Africa, and particularly the political situation in South Africa, in the last month, of course, we've had the reshuffle of cabinet with the replacement of Tito Mboweni with Enoch Godongwana. Of course, Godongwana is not completely pure. We know that he has some dirty laundry in the past, but it doesn't seem to be too bad from what I can read. And of course, we knew that Tito Mboweni didn't really want the job. He's been saying that for a long time, and he has become fairly unpopular with the unions since his hardline stance on government wages. Godongwana, on the other hand, has strong connections with the unions, and he's said to have a high influence inside the ANC. He also has made some quite interesting decisions which look like they are fairly sensible and not populist. For example, he voted against the nationalization of the Reserve Bank, which was big news a little while ago. He's voted against expropriation of land without compensation, and also the recent talk about prescription assets for asset managers. So those are good things. And so far, he's been saying all the right things. He's been saying that he will continue with Mboweni's policies. But of course, the international investors don't really like him because he's an unknown and because he clearly is not going to be Mboweni. They also did not like the appointment of Mapisa Nqakula as the Speaker of the House, because that shows the disregard which the ANC has for Parliament and the democratic system in this country. So those two appointments of Godongwana and Mapisa Nqakula have not gone down well overseas with overseas investors. And the other thing about this reshuffle that's worth noting is that David Mabuza, the Deputy President, and Gwede Mantashe, the Minister of Energy and Mineral Affairs, have both survived the reshuffle. And both of those people are clearly in the Zuma camp. But Ramaphosa has done some things with the reshuffle. He has certainly removed some antagonistic elements and strengthened his position. In the longer term, Ramaphosa having a strong position should be good for the share market. And then, of course, we should talk a little bit about his evidence at the Zondo Commission, because I found that particularly unconvincing. He was testifying about why, when he was deputy president during the 9 years of corruption and state capture, he didn't stand up and say something. But we have always really understood why. If he had stood up and said something about the corruption and state capture, he would have been dismissed summarily. And I know, and we know, that he did not put his 10 billion rands of assets into a blind trust in order to become the deputy president. He always intended to take over from Zuma as soon as Zuma was weak enough. When he finally did that in 2017, he only just had sufficient support. And since then, he's been consolidating his position and getting rid of Zuma supporters. If he had been thrown out, by now, Dlamini Zuma would have been the president. The Reserve Bank and the judiciary would probably have been captured, and the South African economy would have been destroyed. Excuse me. Let's turn our attention now to the economy. Of course, we had the shock jobless figures for July at 34.4%, the official jobless figures, which is up from June's 32.6%. This obviously reflects the impact, the long-term impact of COVID-19, but it also reflects the civil unrest which took place in July. And it's notable that the job losses have been especially in financial services, which obviously indicates a reduction in face-to-face business, in the process which has become known as digitization. People are meeting online. They're not meeting face-to-face. So this digitization process is resulting in some job losses. And of course, now we need radical job-creating reforms, similar to the 100 megawatt license adjustment which was made by Cyril Ramaphosa last month. Many reforms are being held up by the factionalism within the ANC. And at the same time, the ANC has been implementing and talking about populist policies. Obviously, that starts with black economic empowerment, which is clearly a populist policy and very expensive for the economy. Then, of course, there's the national health insurance and the national social security fund, which has been punted at the moment, and also the nationalization of land without compensation. These are things which upset overseas investors and reduce the amount of foreign direct investment into this country, which obviously impacts directly on the rand. Of course, the higher unemployment rate also makes civil unrest more likely. But at least the rumored unrest for Monday the 23rd of August, which was much talked about on the internet, was a flop. That Monday the 23rd of August was a completely normal day. Of course, the police and the army were on high alert, but nothing happened. So that's at least good news. The cost of the unrest, however, is becoming apparent. You can see it in the ABSA Production Managers Index, which fell by 14 points in July. That's the highest fall, the biggest fall ever in a single month. That is due to a combination of the unrest, the level 4 lockdown that we were having, and the load shedding. It should bounce back in August, probably back above the 50% level, which indicates growth. But it was quite a shock to the system. It shows the cost of this type of unrest. Unrest is estimated to reduce GDP growth by about 0.4%, but the third quarter of 2021 should be better. The government's response is to develop the social distress relief package, which is another 350 Rand a month for the 6 million unemployed people in this country and another 3.5 million caregivers, at least until March of 2021. Could be seen as an electioneering ploy, but it will, of course, bring some relief to the poorest people in this country. The massive tax windfall due to the commodity boom has been estimated to be worth about 100 billion for this year. About 1/3 of that has already been spent on the social distress relief package that I mentioned just now. But the rest of it should be able to reduce the government's debt quite substantially. And we expect the commodity boom to continue next year. And it should eventually, if it lasts for long enough, help to get South Africa out of its debt trap, provided the government doesn't come up with more ways of spending the money. It was interesting to listen to Letsetja Kganyago, who's the governor of the Reserve Bank, when he addressed Parliament. He expects inflation to stay at 4.5% for the next 2 years, which is in the middle of the target range between 3 and 6%. Interest rates are expected to stay low until the middle of 2022, which is also good news. But he talked about a serious execution deficit, by which he means, of course, that the ANC talks a lot but never gets anything done. And he says that we have to balance the budget with trade-offs. Money spent on one vote cannot be spent on another, something, of course, which every housewife in South Africa knows. But there seems to be an illusion, especially among some political leaders, that the resources of the government are inexhaustible. Projects are proposed without any thought about how they will be financed. Turning to the rand now, the reshuffle was not welcomed by the international investment community, as I have mentioned. The loss of Mboweni and Mapisa Nqakula's appointment as Speaker caused the rand to fall quite significantly. There is some uncertainty over Godongwana, and the ANC's attitude towards Parliament. Combined with the recent unrest, it caused the rand to fall to about 15 rand 30 to the US dollar. And the rand, of course, is an excellent barometer of international perceptions. The United States Monetary Policy Committee talking about tapering off their quantitative easing did not help. That also had a negative impact on emerging markets and caused a bit of risk-off sentiment to come to the fore. Let us take a look now. This is the chart of the S&P 500. You can see it continues up in a steady upward, strong upward trend here with many mini corrections throughout we are expecting a major correction, as I said, 10 to 20%, which will take it down through this trend line. Let's have a look at the rand because that's obviously important here. I'm just going to go to the chart and see what we can see there. Right. Put a bit more data on the screen here. Yeah, you can see, actually want to put even a bit more on. You can see this part over here where the rand strengthened substantially is what we came to call Ramaphoria. It was in the late part of 2017, the early part of 2018, after he had been appointed first as head of the ANC and then subsequently as president. And then as it became apparent that the cost of state capture was far from over, the rand weakened again, and then it weakened sharply with COVID-19. This spike up here is the switch to risk off in international markets due to COVID-19. And then since that peak in about March of 2020, the rand has been on a strong pattern, a strengthening pattern. Until recently, if we look at the recent data, you can see here there was another bout of risk on here, which is associated with the comments of the US Federal Reserve Bank on tapering. And then there was also the civil unrest, which is there. And then finally the reshuffle. All those things caused the rand to weaken. But now, since those things are fading into the background, we can see that the rand is strengthening again. And has come all the way back down to about 14 rand 50 this morning, from what I can see. And I expect it to continue to strengthen. In fact, I expect it to go down and break through this low point here that we reached in February 2018 in due course. Because our view is that the rand is basically underpriced on world markets. And provided we don't perpetrate any more self-inflicted economic injuries, we can expect the rand to strengthen steadily. Just turn our attention now to Eskom. Andres Dorito, the CEO of Eskom, has put forward a plan to take advantage of what is called concessional finance. First world countries are willing to give away a lot of cheap finance in order to encourage emerging economies like ours to switch from coal-fired power stations to renewables. Dorito is talking about raising 180 billion rand to move away from coal-fired power stations. After all, South Africa is the 11th worst carbon emitter in the world. The recent IPCC report on climate change puts more pressure on countries to move away from coal. That report says that we are very close to the 1.5 degree tipping point, and that the carbon emission in the atmosphere is the highest that it's been for 2 million years. The shift to renewables is also made necessary by new rules that are likely to come out in the European Union next year, where they will impose tariffs on countries who are not applying the Kyoto Agreement and not controlling their carbon emissions. And one of those countries will certainly be South Africa. So if we want to carry on exporting motor vehicles and fruit and produce and other things to Europe, we better get our carbon emissions down. Of course, it's also impossible to get finance to build any more coal-fired power stations anymore. So Dorito wants the 45% tariff on electric vehicles to be dropped, and he wants that to be replaced by an incentive to buy electric vehicles in this country. Predictably, Gwede Mantashe has come out in opposition to Dorito's plan and saying closing the coal-fired power stations would be economic suicide. Hopefully, Ramaphosa will come in and support Dorito in his efforts. Godongwana says that that it's no problem to take this additional finance from the European countries, so long as it stays within the Eskom guarantee envelope. That envelope is for 350 billion rand, and Eskom still has about 120 billion left in that envelope. Notably, Medupi power station was finally completed 6 years later and almost at double the budget amount. But clearly, it is already out of date and is a dinosaur in this market. A report by the National Business Initiative, the Business Unity of South Africa, and the Boston Consulting Group said that South Africa could be carbon neutral by 2050, but it would cost 3 trillion rand. Well, it's nice to dream. I cannot really see that happening myself. All right, let's turn our attention now to some companies. I'd like to begin with Life Healthcare, which of course is the second largest healthcare company listed on the Johannesburg Stock Exchange. I'm just going to put a bit more data on the screen here. You can see here that Life Healthcare has been in a downward trend for a long time, since 2014. But it's recently broken up out of that downward trend. Nice breakup over here. The company has hospitals, day clinics, surgeries, and so forth. It's got operations in South Africa, the UK, and Europe. It's got altogether over 9,000 beds. In the year to the 30th of September 2021, it produced earnings per share which are expected to be double what they were in the previous year. Of course, they're coming off the low base of 2020. We mustn't forget that. The share is a rand hedge. It's also in the defensive medical or health sector, which is always useful. And it has overseas diversification, which is also a good thing. The long-term downward trend has been broken, so we see this share as entering a new upward trend. The next share I want to look at is Nepi, which, as you know, was part of the Resilient group of companies and took a bit of a hammering as a result. But we see this share as moving into an upward trend now. You can see here the hammering it took with the 360 asset management report on the Resilient group and their cross-shareholdings, which has now been basically completely debunked. But nonetheless, it caused the share price to fall. This is the impact of COVID-19, you see here. And then it reached a low here, just below 60 Rand in November 2020. But we believe that it's now in a new upward trend. So this is a share to look out for. It's a great Rand hedge share. And it has been breaking to the upside as the pandemic comes under control in Europe. In the 6 months to the 30th of June, its collections were 94% with a 95.6% occupancy rate. So we think the share will be good and will continue to rise well above 100 Rand. Solid long-term investment. Shoprite Checkers is one of it is our biggest retailer. It's the biggest grocery retailer in Africa, in the whole of Africa. Retail, of course, is a tough business, but this company is very interesting. You can see here we proposed quite a while ago that you apply a 200-day moving average to the share price and wait for a breakup. That breakup came, as you can see here, on the 7th of August 2020 at a price of 114 Rand and 56 cents. The share has since moved up to 183 Rand and 85 cents, which is a gain of 60% in a year. That's the kind of investment you want to be trying to make as a private investor, and I hope some of you did take advantage of that. It's changed its policy on Africa, withdrawing from Nigeria, Kenya, Uganda, and even other countries in Africa. It says that it's been making market share gains for the last 16 months during the COVID period. It's opened 147 stores this year, and its merchandise sales were up 8.1%. It estimates that headline earnings per share will rise between 22 and 32% this year. Unrest damaged 119 stores, but then you have to remember that it's got nearly 1,200 stores. It's now agreed to buy the 56 stores, the Cambridge and Rhino stores from Massmart, so that will obviously expand its network. But I think this share is in a strong bull trend, and it's a share that you should definitely be looking at. Okay, let's turn our attention to the construction industry. William Bailey Holmes Ofcon, WBHO, interesting share. We also think this share may be heading into a new upward trend. Just going to put more data on the screen there. You can see here there's an upside break above its long-term downward trend line. It's now South Africa's largest construction company with a market cap of around 7 billion. It has operations in Africa to the north of us, also in Australia and the UK, but most of its business is now outside South Africa. In the year to the 30th of June 2021, its headline earnings per share came in at 600 cents profit compared to the loss of 923 cents that it made last year. It's benefiting from an increase in infrastructure spend in South Africa. So this is another share that you could arguably look at. Then I'd like to suggest you look at Blue Label Telecom. Blue Label is obviously a very interesting share, quite controversial, but we think it's in an upward trend now, having performed a virtually perfect head and shoulders formation, reverse head and shoulders during 2020. The company bought 45% of Cell C in September 2016 for 7.5 billion rand. 3.9 billion of that was paid in Blue Label shares. Cell C has been now completely written off as far as Blue Label is concerned, so it doesn't appear on their balance sheet at all, but it is still an asset and could be a benefit in time. We suggest that Blue Label is in a long-term upward trend now. We suggested buying it when it broke up on the 26th of May 2020 at a price of 259. It's now trading at 586 cents, which is 126% gain in 15 months. So that was also quite a good investment. We'd like to talk to you about Sibane. We're all familiar with Sibane as the largest producer of platinum group metals in the world, mainly due to the efforts of Neil Froneman. Neil Froneman has taken that share from a low point of 7 Rand in July 2018. He took it all the way up here. It was trading at its peak at around 70 Rand, 72 Rand. But for the last 6 or so months, since February this year, it's been in a downward trend. And what is interesting about this company is that Froneman himself says that the share is now heavily underpriced and should be re-rated upwards. We agree. We think Froneman is probably right. This share, although it's a speculative commodity share, may well be at a point where you should be buying it. All right, then I'd like to just finish off by talking about Avenge. We have written an article about Avenge, but it's an interesting little company and one which you can learn something from as a private investor. So I'm just going to put a bit more data on the screen. This is a share that we wrote an article about some time ago, and we suggested that when it was around 3, 4, 5 cents, we suggested you should possibly take 10,000 Rand and speculate in the share. We followed our own advice, and you can see we bought 10,000 Rands worth of shares here. We actually ended up with 250 million shares because we paid 4 cents each for them. Then this share, the company did a rights offer in February this year. In that rights offer, you got 103 rights for every 100 shares that you already own. So it basically doubled the size of the share capital, the issued share capital. And it did the rights offer at 1.5 cents. We took up our rights, and then it did a follow-up rights offer a little bit later, also at 1.5 cents, and we followed that as well. So we ended up with 566,000 Avenge shares, which we paid an average of 2.6 cents for. As you can see here, the share has been trading at around 6 cents. In fact, just a couple of days ago, it went up as high as 7 cents. So when it was at 6 cents, and we think that it's fairly solid there, our profit on our investment, speculative investment, of I think it turned out to be about 14,700 Rand in the end, is 130%. So we have more than doubled our money in this spec. And we also have a client that I was talking to the other day, and he said he has 31 million Avenge shares. And he paid an average of 2.5 cents for them, so he's made more than R1 million profit on this. I hope that some of you have been able to benefit from this call in Avenge. We still think the share will rise further. in their financial results, which were reported yesterday. In fact, they produced a headline earnings per share of 2 cents a share. So if you look at the share trading at, let's say, 6 cents, if it's making a headline earnings of 2 cents, then it's on a price earnings ratio of 3, which is very cheap compared to the JSE's average price earnings ratio of 13, and of course the Wall Street's price earnings ratio, which is 35. I mean, there are many good reasons why a share like Aven should trade on a much lower PE than either the JSE or Wall Street. But we think that the share price will move up to more reasonable price earnings ratios in the near future. Ladies and gentlemen, that's about all I have for you today. I hope that you enjoyed the presentation and you got something out of it. I will talk to you again on the first Wednesday of next month. Thank you for listening.